do you still see signs that we can enter what you called a Great Depression?
Yes, well, I hope it's not the Great Depression, but everything seems to be leaning that way. What you led into there with a potential recession in the U.S. is still coming based on Bloomberg economics and based on my views and based on what you see in the things, indications for the yield curve. But it's actually happening already at this point in Europe. Let's look at U.S., for example. Normal recessionary correction means probably you usually get peak to trough, the S&P to correct at least stock market, at least a third from the peak. Now it's still almost near that peak. So I think that means it gets near 3,000. That's very simple math, partly because where was the market right before COVID? Right around 3,000.
Senior Bloomberg analyst Mike McGlone is predicting a severe global economic slowdown in the coming months, drawing parallels to the Great Depression of 1929. He anticipates that this economic downturn will become evident following a significant drop in U.S. stock prices. The 1929 Wall Street crash, often seen as a direct cause of the Great Depression, was exacerbated by the speculative boom of the 1920s, which McGlone suggests is mirrored in current events. McGlone highlights the unprecedented liquidity injected into markets by central banks during the pandemic, asserting that the effects of these policies are catching up with us. He believes that the stock market is overdue for a correction, especially considering the fragile conditions in major economies like China and Europe, which he thinks will amplify the challenges and lead to dark times for the global economy. Despite McGlone's concerns, other analysts foresee a Bitcoin price surge in early 2024, driven by the approval of a spot Bitcoin ETF and the 2024 halving event. However, McGlone remains skeptical, suggesting that the macroeconomic situation may prevent assets like Bitcoin from rallying solely on fundamentals during increasingly chaotic times.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Crude oil was right around $60, 57. Now it's gone within 10% of that level. So there's the autocorrelation of crude oil. It was at that level right before the big pump in liquidity, and it's back down. The most significant one of that that's going to matter the most is I think people need to never forget in markets from where they're from. Where did the market come from before this event happened? So normal reversion in a normal recession for the S&P 500 is probably around 3,000, particularly if we tack on what we did in terms of pumping liquidity in the system. The 50-week average right before COVID, 2019, at the end of the year was around just below 3,000. So I've heard pushback is people say, oh, it's so different in Bitcoin. The problem with Bitcoin is it's a baby. It still is the highest volatility in the space. Yes, I see all the big picture, I still agree with it. Decline in supply, it's going to become global digital gold. But the problem right now is it's the best performing asset in the history of the world. And what really created this asset to perform so well? Digital gold in a zero interest rate environment? Yeah, okay, that works. We're going digital. Now that was what pumped Bitcoin to the best. It's still, if it drops to 10,000, it's still probably the best performing asset ever. So that to me is a problem. In a shorter term, that's the macro. If we have this downturn, you just take money away from everybody, which is kind of a rule in bear markets, Bitcoin will suffer. The key point is we need to see at some point it to start showing divergent strength, where it trades more like treasury bonds and gold in a deflationary environment. And it hasn't been doing that. It peaked basically at the end of Q1, got to around 31,000 on this hopium and ETFs, and it's dropped back down around 25, around 26 now. It's showing divergent weakness to the stock market going up. I need to at least see signs of as a trader, as an investor, you need to see signs of the oomph. And then you look at overall all the other altcoins. I mean, a lot of them could go to zero with what's happening with regulation. I mean, are they not securities? Why not? I mean, so this is what I see for Bitcoin. It's the number one crypto that matters. I think eventually it's going to get to 100,000. But if we get the global economic reset, I think we get a normal deflationary recession, housing coming back down, stock market coming back down, similar to 2008, but this is actually in some cases worse because we're still taking liquidity from system. Bitcoin is a great leading indicator, and that's my point. Lately, it's been kind of leading the way down. It got up to around 31,000, and it's been tilting back lower. So I'm looking at it as a leading indicator for most risk assets. So I like to compare Bitcoin. The rally in Bitcoin was very similar from basically 10 years ago to the peak in 21, 22. It was very similar to the stock market in 1921 to 1929. And the big difference is the Federal Reserve started cutting rates in Q4 29. The difference is right now we're still taking away that liquidity. So this is going to happen. I think it's going to, but not without bumps in the road. So here's a simple fact. The 100-week moving average of Bitcoin is trending down, most significant in its history. This is what you expect in the asset that's maturing. And the recent bounce was near that average. So trend is heading lower and the Fed's still hiking. There's bad things going on for Bitcoin in the macro. Now in the micro, we still hope to get those ETFs in the US. At some point it'll happen. But even if the ETFs come on, and when they do, they'll come. Where's that money going to come from? From people who are typically invested in equities. If you're losing money in the equity market and your volatility is 10, 20%, and you can get 5% in 2 notes, and Bitcoin volatility is 50, 60%, Bitcoin's still a toy. And so I think it's going to take time. We got to get through this, and maybe I'll be wrong about this great reset. If that's the case, then maybe Bitcoin will be a leading indicator on the way up.
Mike McGlone, a senior commodities strategist at Bloomberg Intelligence, holds a short-term bearish outlook on Bitcoin. Despite this, he dedicates a significant portion of his career to analyzing commodities, including Bitcoin, and finds the leading cryptocurrency's behavior unprecedented. McGlone asserts that even if Bitcoin's value were to drop to $10,000 or $8,000 per coin, it would still maintain its status as the best-performing asset of the past decade. Moreover, McGlone envisions a future where Bitcoin matures, becomes less volatile, and emerges as a leading market indicator influencing the price movements of other assets. However, he anticipates a challenging period before this transformation occurs, predicting what he describes as the most severe recession of our lifetime, reminiscent of a Great Depression-like slowdown that will impact the global economy significantly. For additional insights from the interview, please refer to the provided clips.
I hope it's not the Great Depression, but everything seems to be leaning that way. What you led into there with a potential recession in the U.S. is still coming based on Bloomberg economics and based on my views and based on what you see in the things, indications for the yield curve. But it's actually happening already at this point in Europe. The economic revision data that's heading negative in China is getting quite extreme. And I think it's just a matter of time. We're going to see, it's already basically kicking in Europe. PMIs, services, and manufacturing are both negative, yet rates are still going up. See that recessionary trajectory, and there's a war going on. We're certainly seeing a contraction of a slowing of economic growth, and certainly expectations in China. And my question I asked, what makes that get any better with their number 1 and 2 customers, Europe and US, tilting that way? And to me, it's just a matter of time that this starts continuing. It's also, the foundation is extraordinary. It's historic. We are just heading towards, we're in the dump phase of liquidity from the biggest pump in liquidity ever, bar none. Maybe in the 1921-29 period in the US was similar. And it's just getting started. It's the key thing I like to point out is in Europe, they still have projections for rates to go up despite the tilt towards recession. The war is obviously still going on. In the US, we still have, if I look on the Bloomberg terminal at the September and November meetings, we still have expectations the Fed might hike rates, still hiking rates. Yet we're at 5.4% upper bound in Fed funds, and CPI is 3% year over year, and PPI year over year dropped to minus 3%. It's the bodies and motions that are very, very disconcerting. Then you look at bank credit clearly declining. Personal savings clearly declining. And the biggest problem is this lose-lose with the Fed still tightening. Part of the reason they're still tightening is because the stock market's going up, partly because it's had a decent amount of fiscal stimulus, but that's a lose-lose. That fiscal stimulus is going to go away, yet that liquidity being taken away from the system, I think, is what's going to tilt everything lower to a normal recession, reciprocal of the liquidity pump that we had that's dumping in. I guess that's kind of the big picture macro.
Why haven't we seen these cracks happen yet?
So I prefer, and I think it's important to focus on what I got wrong, and I was early, or both first. And that's, yes, I tilted with that recession trajectory. I still agree with it early. I was way early in thinking crude oil would collapse from 120 back down. I still think it's got a lot more to go, just on normal recession trajectories. But it's trying to measure unprecedented pumps in liquidity, unprecedented events, and projecting what's going to happen. So I'm looking back to the macro big picture. We threw so much money at this system. There's still lingering effects from that, but it's going away so fast. Just look at things like mortgage rates and existing homes for sale. They're collapsing. You have to go to new building of homes, new homes under construction, which is almost the highest ever, which really means it's going to peak, and there's just a collapse waiting to happen there as that supply comes on and people just can't buy or sell anymore. So that's one of those trajectories. But I look at it as it's such a big picture macro view. It's such a substantial cycle. It'll be the biggest one of our lifetimes. Now I'm 58. I think I'm using a lifetime. Typical person lives to be around 80. And I think this is going to be the one we're all going to look back on and say, yeah, that was like the Great Depression. The key question is, right, the problem I have with it right now, Michelle, is I don't see what stops it. So typically we'll just give the last two examples of the bear markets in the U.S. stock market. They bottom. Let's look at 2009. That was the last time we had a bottom in the stock market. And the S&P is up 600% since that period. That's not including total returns, and that's on the back of zero interest rates. Historic. We've never had interest rates that low. But that bottom was in March 2009. The Fed started easing in September 2007. See the trajectory there? We're still tightening. The bottom before that was in around 2002. I think it was Q1. The Fed started easing in the beginning of 2001.
As per McGlone's assessment, the likelihood of a recession signaled by the yield curve is at its highest since 1982. He also posits that the stock market is enticing the Federal Reserve to announce further interest rate hikes. The more the Fed withdraws liquidity from the markets, the closer we come to a scenario of widespread chaos, as predicted by McGlone. Adding to these concerns is the ongoing crisis in China, where Evergrande Group, the country's second-largest property developer, has recently filed for bankruptcy protection. It's worth noting that China's property sector contributes to over a quarter of its economic activities. Considering all these factors together, McGlone suggests that a crisis is imminent and will have a substantial impact. The only scenario he believes could potentially avert his Great Depression thesis is if the conflict in Ukraine suddenly ceases, leading to a change in China's regime, ushering in capitalism and the end of repression in both China and Russia. We invite you to share your thoughts on Mike McGlone's predictions regarding Bitcoin, U.S. stock markets, and the global economy. Please feel free to express your opinions in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.